We're sticking with it. We're overweight on equities, on gold, and on high grade investment grade as well. So it is a bit of a mix of safe haven assets and the riskier assets, and it basically points you towards the main drivers of this upward trend, which is this global liquidity. I think when you're looking at the daily news flow, you're going to have ups and downs, and clearly as we get closer to the US elections, some of the volatility may increase. Also, obviously, markets have had a big run, but the 4 L's are going to support the market in terms of trend. And so those 4 L's are, number one, that liquidity and the tail risk reduction because of policy measures. Secondly, the relatively low expectations that investors have around earnings. Now, analysts have started to upgrade those, but certainly still earnings expectations are relatively low, and markets have benefited from that. The third L is low positioning. Investors are quite skeptical, a lot of cash as well with our clients, but also when you look at surveys, US investors only 23% bulls, usually that's between 20 and 45, so we're at the bottom end. And then lastly, the market tends to look forward. You may have volatility in the data from day to day on the economy, but clearly people are looking forward towards a reopening. When you look at the PMIs as well, managers are telling us that the forward-looking, they're more positive about the future than what they are about today. So all of those should continue to keep support for the equity market. That being said, volatility may pick up somewhat.
In recent sessions, we've seen a clear preference to rotate into cyclical value away from the technology drivers of recent months. Is this a meaningful shift in investor behavior now, or do we go back to the momentum of growth stocks?
Yeah, we continue to have, technology as an overweight, growth stocks overweight, the large caps overweight, the quality overweight. So we're not really chasing that rotation into low quality, into overly cyclical sectors. So we have a neutral exposure with regard to the cyclicality. We have overweight such as telecom, technology, but also healthcare. We're underweight utility. So it's a mix, and it's neither here nor there in terms of cyclicality. The reason for that, the reason why we stick to quality in particular, is that although we have a reopening, it will be not a V-shaped, it will be a U-shaped, a swoosh, or whatever you want to call it. It will be an uneven recovery. That's the most important one, where every company is positioned somewhat differently in terms of what is their cash flow going to be like, and also what is the strength of their balance sheet. And the Fed has recently warned that, with regard to interest rate coverage, the number of companies below 1 times interest rate coverage has gone from 18 to 25% just in the past quarter. Lending standards are starting to be tighter. So the quality of the balance sheets remains important. So therefore, we are not going into the low quality. We continue to stick with quality stocks.